So cost is an expenditure, and which can be categorized based on the short-term expenditure or long-term expenditure. Short-term expenditures are called revenue expenditure, and long-term expenditures are called capital expenditure. Now, revenue expenditure, we can classify it further through functionality using cost of sales, distribution cost, administration cost, research and development cost, and finance cost. And we can even go further by looking at the nature into the cost of sales and break down that there is direct cost and indirect cost. And we can even go further than that and say by element. So cost of sales being direct cost, it also has components such as direct labor, direct materials, and direct expenses or direct overheads. And we can even go further and say certain cost does have behavior, so classification by behavior. And some costs have variable attributes which varies based on the production level. Other extreme is fixed cost, which does not move based on the production activity. And then we've got two hybrids here in the middle, such as semi-variable and step fixed costs. Semi-variable has got both attributes of variable element and fixed elements, whereas a step fixed cost is fixed temporarily, or to a certain range is fixed before it increases again. Hi, welcome to 365 AAT Education channel, and today we're going to look at costing. So it's part of the management accounting to start off with looking at what is costing. Now, costing you will find as part of the introduction chapters, one of the early chapters within management accounting. And just to get an understanding, management accounting is a type of accounting which is designed to prepare information for managers' decision making. So it's basically geared to look at three areas, and these areas are mainly planning, controlling, and decision making. Now, in level 4 of AAT, it talks of goal congruence. So this is more of an advanced area, but so far we can stick with these three main objectives. So managers' roles are for planning, controlling, and decision making. Now, planning means if we take into an understanding that businesses, especially manufacturing, before you even start production, you want to start with the planning. How much do you want to produce in this forthcoming period or in this year? How many units do you need to produce? So that is part of the planning. So management will sit down and plan about their production levels. So management accountants are there to help them to prepare those planning and also controlling. So you want to control your activities to ensure that they're in line with the plan. And thirdly, at the end of the period, you want to decision making. Decision making involves partially performance review, areas to look at where you've done good at, areas to look at where you've done poor at, and areas where you want to improve in the next round period. Now, management accountants, before it was called management accountants, it was called cost accounting. Now, to understand or to start making plan ahead, you want to understand your costs. Now, what is cost? Now, management accounting has got various ways in which to look at what is cost. In any business, if you don't understand your cost, you're not likely to survive in that industry. You're not likely to strive in that industry. You're not likely to make profit in that industry. So the starting point in any business is to look at their cost. And how do we see cost? Or how do we define what is cost? Now, this is strictly and specifically to management accounting. Cost is defined as expenditure. Right? Cost is expenditure. And therefore, as we see the expenditure, we can group expenditure into two types. There are two types of expenditure. We can have revenue expenditure. Also, we can have capital expenditure. So we have categorized expenditure based on revenue and capital. And what is revenue expenditure? So revenue expenditure, these are, if you would like, these are short-term expenditures within the business. Now this includes part of production cost, part of non-production cost. These are expenses. So revenue expenditures are also called expenses, and these are running costs of a business. While capital expenditures, these are long-term expenditure, and they involve in acquisition of non-current assets or fixed assets, things like motor vehicles, things like fixtures and fittings, things like land and building, things like plant and machineries, office and computer equipments. These are capital expenditure. They are likely to be used for more than one accounting period, and an accounting period, a standard accounting period, is 12 months. So if an item which is purchased is going to be used for more than 12 months, that is likely to be classified as a capital expenditure. Now, looking at revenue expenditure, we can further look at revenue expenditure by categorizing it based on the functionality. How is the revenue expenditure being incurred? We can look at it under functionality basis. And functionality basis is mainly used by financial accounting. And for those who you would like to understand more about financial accounting, you can look at my other videos on bookkeeping and financial accounting and see how analysis by functionality is mainly used or predominantly used in those areas. Now, in a very quick summary, analyzing revenue cost under functionality, revenue expenditure under functionality will include categorizing cost based on why they have been incurred, on what function, on what basis have they been incurred. So basis number one will be cost of sales. Basis number two will include things like research and development. It will include distribution cost. It will include administration cost. It will include finance cost. Those are functionality basis, categorized by function. And looking at this, we can even go further and say by nature. So by nature would mean part of this list that I've just mentioned, from cost of sales to distribution cost to administration cost to advertising costs to finance costs. These costs can be seen as direct cost or indirect cost. Now, what does direct cost mean? Direct cost means the cost incurred can be traced directly to the item produced. Now, if you can actually trace the expenditure to the item produced, then that cost is referred to as a direct cost. And if you can't trace it to the end product, then that cost is referred to as indirect cost, and that is cost by nature. Now, we can see from here, cost of sales, these are direct costs. And cost on distribution, cost on administration, and cost on finance cost, they are not easily directly attributed to the item produced. Especially if an organization is producing multiple of items, then in that case, then it's harder to attribute this cost, direct cost, administration cost, advertising cost, and finance cost into the product. But however, it's easier to trace the cost in terms of cost of production into the unit, into the produced unit. So therefore, we have further analyzed it by nature. Now we can even go further by analyzing this by elements. Now, for an example, cost of sales or cost of goods sold, we can zoom in and look at it in a sense of elements. What's the components of cost of sales? Now, in our manufacturing, which will be the industry we will focus on in the traditional management accounting models, which is more practical that way, we can see that in terms of producing products, the main components that you will have to incur, there are three main components. Now, component 1 is materials, component 2 is labor, and component 3 is expenses or overheads. Now, with the elements, these elements, they can be combined with nature. So nature and elements, they can be combined. So what you can have is direct cost with 3 elements and indirect cost with 3 elements as well. For an example, direct material, this will mean either the plastic that goes into the pen, the ink that goes into the pen, that will be a direct material. And for an example, a direct labor will be the machine operative. So the workers who are working directly to fit in and make up that pen, these will be the direct labor. And direct expenses, this will be, it could be royalties that are given to the designers of this product. And similarly, if we look at the indirect materials, this could be the lubricants or the parts or the materials that goes within the machinery, or it could be cleaning products for the factory that are needed to keep the factory tidy and ready, or machineries fit and that they can work effectively during the production. And indirect labor will include things like supervisor salaries, who they don't necessarily work producing the item, but they oversee workers who then produce the item. So their wages and salaries for supervisors, this will be classified or deemed as indirect labor, while the wages and salaries for machine operatives, this will be a direct labor. And indirect expenses or indirect overheads, this will include things like rent and rates or factory costs that goes into the production cost. So we have now looked at analysis by the elements. We can further look at cost in a more modern way by looking at the way they behave. Now, cost will sometimes behave different depending on the production activity or production level. Now, we have 4 types of areas where we can group this cost based on their behavior. For an example, if I am starting my production, the cost that I would incur as a result of starting my production, which I wouldn't have incurred if I'm not doing my production, these are called variable costs. Variable costs are likely to increase proportion to the production level. So for an example, the more I produce, the more units I produce, the more of this cost I will incur. And in reverse is also true. The less I produce, the less of this cost that I will also incur. So if I don't produce anything, if my production is at 0, I would theoretically incur 0 costs of this type of cost. The variable cost, there will be 0. And they will increase proportionally as my production level goes up. Secondly, on the other extreme, we have some types of costs that have no relationship or they have no bearing with the production level. And these types of costs are called fixed costs. So fixed costs are also seen or deemed as periodical costs. So these are costs which are committed for a specific period. So whether there is a production or there isn't a production, it doesn't matter, as this cost will be incurred irrespective. So some of these will be, for an example, rent and rates. Now these expenses are derived from the premises or the factory. So whether the factory is in production or is out of production, this cost will still be incurred as long as the contract is still valid. And the other type of cost are insurance. For an example, an insurance, if you got an insurance from January till December, whether you have motor vehicles functioning during that period, these costs will be incurred. Or machineries, insurance on the machineries, this cost will still be paid whether the machineries are working or not, because you are paying it for the period and not for the production of it. So these are the two extremes. So you've got one extreme, you've got variable cost, which moves proportion with the production, and on the other extreme side of things, you have fixed cost, which does not move at all with the production. So, and then we have the hybrids here in the middle, and these hybrids are sometimes called semi-variable. We've got a semi-variable, and we also got a stepped fixed cost or stepped cost. Now, semi-variable is the type of cost, really. We're trying to be more practical here. So we are moving from extreme ends and we are moving into more practical, where more cost will likely to be into. So semi-variable are the type of cost where they have both elements. They've got some elements of fixed cost and they've got some elements of variable cost. Now this type of cost will be such as a mobile phone or telephone, where you get a fixed amount of calls, minutes, and mobile data, and once you've utilized the contractual service, you can extend that, but you're gonna have to pay for every usage. So for an example, if you're in the country, you probably are on the contract, but when you're in international, you're probably using data or roaming data, where you will be charged based on the number of users. So that is a type of expenditure which has got both elements. It's got a variable cost and it's got a fixed cost. So there are techniques on how you can split this, but in a very simplistic way, there is a technique called high-low method, which we will look at that later in further programs and see how we can work that out. But we also have stepped fixed cost. Now, stepped fixed cost, these are fixed costs, but then they are fixed up to a certain limit, and then they increase as the usage of that expenditure increase. For an example, many organizations might have a ratio. For an example, you might have 3 workers for 1 supervisor. 3 workers for 1 supervisor. So when you have 1 worker, you can increase the second worker without having to increase the cost of supervisor. You can increase even to a 3rd worker without having to increase the supervisor. But when you're increasing to the 4th worker, now that ratio will be exceeded. So you would need a 2nd supervisor. And once you have the 2nd supervisor, you can have the 4th worker, 5th worker to 6th worker. But before you get to the 7th worker, you'll have to increase another 3rd supervisor. So you would see that supervisor has a range of 3 workers. So that cost of supervisor will be fixed until you get to 3 workers. After 3 workers, it will be fixed until you get to the 6th worker, and the 6th worker will be freezed over there until you get to the 9th worker and 12th worker, and so on and so forth. So you can see, if you even show it on the graph, it looks like stairs, hence why it's called steps fixed costs. So these are the types of costs that we have managed to classify. So Cost is an expenditure. Just to summarize what we have discussed already. So cost is an expenditure, and which can be categorized based on the short-term expenditure or long-term expenditure. Short-term expenditures are called revenue expenditure, and long-term expenditures are called capital expenditure. Now, revenue expenditure, we can classify it further through functionality using cost of sales, distribution cost, administration cost, research and development cost, and finance cost. And we can even go further by looking at the nature into the cost of sales and break down that there is direct cost and indirect cost. And we can even go further than that and say by element. So cost of sales being direct cost, it also has components such as direct labor, direct materials, and direct expenses or direct overheads. And we can even go further and say certain cost does have behavior, so classification by behavior. And some costs have variable attributes which varies based on the production level. Other extreme is fixed cost, which does not move based on the production activity. And then we've got two hybrids here in the middle, such as semi-variable and step fixed costs. Semi-variable has got both attributes of variable element and fixed elements, whereas step fixed cost is fixed temporarily, or to a certain range is fixed before it increases again. Thank you very much, and please don't forget, if you enjoyed this video, please don't forget to like and subscribe to get future notification of similar videos. Thank you. Bye.